So there can be some very unexpected consequences, and that's why I believe it's so important for people to get all of their records together, find a professional that they're comfortable with, and get some real advice on how you navigate through all of these different options of litigation, receivership proceedings, making a SIPC claim, how any of that or all of that can affect your tax planning and tax strategies. We call the tax planning the gold standard here because perhaps the greatest recovery here, unfortunately, will be in the form of tax refunds or other tax benefits that are available. Because if there is a $50 billion loss out there, and there are only millions of dollars or a couple of $1 billion to address it, obviously that's a small percentage.
Oh my gosh. You know, the point about becoming a defendant, I don't think has really been made clear to people. You watch news reports that, you know, as this scandal has unfolded, and I can't remember a single news report, you know, that alerted those who've been victimized that they might in fact become defendants. That's shocking.
I think there's only so much bad news people can handle at one time. Right. And what we're talking about here is it's a law called...
If you took the 12% dividend out for the last 6 years, you may be on that list. So it's like more injury and more pain on top of everything.
Well, that's exactly right, because there's a concept called preferences, and some investors shouldn't be treated better than others if, in fact, the whole thing was one big fraud.
Right, but it's 6 years going back. Oh my, it's just
Well, there are going to be different
stunning.
standards. Some preferences are based on 90 days, some are based on a year, and some arguably could go back 6 years. It depends which federal or state law you're operating under.
So you basically, if you're caught in this mess as a private investor or as even a fund-to-fund manager, you need really competent tax and legal advice every step of the way to make sure you don't step on your own toes.
That's exactly right, and that's why we say don't rush to do anything too quickly, because what we know now is a very small part of what we'll know, for example, a year from now. And, you know, for example, Rick, I'm going to ask you, you know, most people when they file their tax returns, are they going to be able to take extensions and wait until perhaps October before they have to take a position?
I think they're going to have to. I mean, what we're going to see when I talk about the tax side of it is that this is very fact dependent on making the maximum use of your tax losses here, and a lot of the story that's not told yet is going to affect the years in which those tax losses might be available, how much might be available. So. It's a time to, as Steve says, gather information.
And that's why we don't want people locking themselves into certain litigation positions, which frankly can mess up tax opportunities that they may have. They really should be able to make that informed decision when we have more information. And there's a court-appointed receiver, there's likely to be a court-appointed bankruptcy trustee, there's going to be a team of lawyers and forensic accountants trying to unravel this. You know, one of the other things every Ponzi scheme has in common is there's at least two sets of books. You know, before we started this, you had made a lighthearted comment I thought was pretty apropos, where you said, oh, it's Bernie Madoff with the money. And that's what people have to find. How much of the money can we trace? What was really taken? What can be recouped? The numbers don't really make sense at this point. When we talk about even how much the losses are, we may find it's not $50 billion, but that's a fictitious number that's been put on a bunch of account statements. It may turn out to be much less than that, but it's too early to tell.
Well, okay, well, let's take a break. We're going to go to the finest known facts, and we're going to come back and pick up where we left off. Welcome back. We have with us counselors Stephen Katzman and Richard Lehman. Richard, you're the tax expert. It's a very complex subject matter when you're looking at any tax situation. But in this one, there are lots of minutiae involved here on how to interpret the tax law. And even though it's fairly complex, I'm going to ask you to try to bring our viewers through this on some of the key points and things that they have to know from a tax standpoint if they've been caught up in this $50 billion Ponzi scheme.
Very good. I'm afraid it's not going to be as sexy as the discussion that you had with Steve. But we do need to go through a few fundamentals. We start with the fact that a Ponzi scheme is recognized as a theft loss by the Internal Revenue Service, which is about the only good thing that one sees in this whole mess. The theft loss is, I've been calling it the gold standard of a deduction. It's an ordinary deduction, so for almost every Madoff investor, it's going to mean a return of 35 cents on the dollar for every tax loss that you can deduct against other income. It's for people who live in jurisdictions where there's city and state taxes, it may be as high as 50 cents on a dollar recovery. It comes from a strong payer, the United States, and it's going to come with a lot less angst and a lot sooner than litigation is going to come.
Now, from the tax standpoint, and I don't mean to interrupt you, the subtle thing is if you lived in New York State and that was your residency, you may be able to collect a tax benefit from the state as well, as opposed to if you live here in Florida and this is your residency, you don't have a state income tax,
Right.
so you would be limited to the 35%.
Right.
Okay.
Right. Because most of the state taxes key right off of the federal income tax return, and your write-offs are going to go back and reduce all that income. So the theft loss, the value of it, 35 cents or more. It has a 3-year carryback, which is another very positive because it means there's the opportunity to get cash refunds by arriving at your theft loss and being able to take those losses back if it's 08 into, use them in 08, 07, 06, 05. There's a 20-year carry forward, which means that all of the losses that aren't used up can be carried forward and offset against future income. And these losses that are carried back can be offset against any ordinary income that you've made in the past. So there's potential claims for refunds that in a lot of Madoff cases are going to mean the only real substantial cash that anybody's going to have after this debacle is over. Now, there's 2 other sources of recovery from tax losses that we'll talk about. In addition to the theft loss, they both represent ordinary income also. They are a little more particular. The facts need to be almost perfect to take real advantage of this. But if this really has been a situation where there was no real capital there and it was money in, money out, then,
Meaning he lived on the expenses.
well, it went out
Right.
to pay new
Right.
pay investors. Plus, he was living on it. If you do have that, everyone is going to have a lot of phantom income, not real income. They're going to have paid taxes just on bookkeeping entries. That'll be captured by your theft loss, and you'll be able to claim a deduction for the taxes that you had to pay on these phantom income items in the past. The other is that it's possible that some people had actually got back recoveries of money that were taxed to them as taxable income can claim, no, it wasn't a recovery of income. There never was any real income. It's a recovery of my principal, no taxation. And also, instead of by using a theft loss, they simply by saying, I'm going to amend my return and call that a return of capital, not income for these last 3 years, have a chance of taking those same ordinary deductions. But that's not quite as easy to prove and what have you as the theft loss deduction.